Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest on the program with us today is Jordan Roy-Byrne. He is the publisher of The Daily Gold, which can be found at thedailygold.com. Jordan, welcome back to the program.
Hey, Colin. Thanks so much for having me.
For sure. And we were going to do this a couple weeks ago, and we got on a call, and then we said, what to talk about? And the gold market is so kind of just lackluster and in the boring phase right now, I guess you could say, that we said, let's reschedule this for a couple weeks. And I think we're still kind of in that boring phase, but it's worth having a discussion about it. So let's start there. Where are we at?
Well, I think where we're at, Colin, is simply put, the market failed to break out in the spring. And so you're seeing people that bought in over the last year or so, people who are more traders and not diehards, they bought in anticipation that gold was going to have a big breakout. It failed. And in addition to that, the dollar, which supported gold in 2017, it really prevented gold from having a bad year when the fundamentals weren't that great, in my opinion. The dollar now is consolidating its recent rally. It's above the long-term moving averages. So the market has been more boring with respect to the miners. I'm looking at GDX and GDX.J, and they've been basically going sideways for a while, which is somewhat encouraging. But gold, as we know, has, it failed to break out, and it's broken down. Silver is looking very weak. I mean, it's on the cusp of breaking down out of a triangle. So I think where we are is we're kind of shifting back to bear market mode. But as we've been talking about, you and I, for the last several weeks, I mean, we're not going to go back into some kind of bear market that's going to last years and years. I think it's potentially we could be setting up for some kind of a washout in the next 6 months or so. There's still some things that have to happen for the market to make its next bottom and then to get into a bull market, which I'm sure we'll talk about. But simply put, that's kind of where we are. We're moving from a boring market, I think, to a potentially dangerous one. I hate to use that word, but it could be dangerous on the downside over the next 3 to 6, 9 months if people aren't careful. Okay, well, let's compare sentiment to prior to January 2016. I remember then people couldn't raise money no matter what. And right now, juniors, I'm seeing emails every day closing $500,000, $1 million, a few $1 million. So things are not even close to as bad as they were. Are you afraid that there could be a double bottom where we do approach those levels of 2016 before taking off? I would say I'm afraid of that with respect to the metals, but less so with respect to the shares. I'm definitely looking for more downside in both the metals and the shares, but I think with respect to the stocks, they've already started to show a little bit of relative strength against the metals. And I don't know if there's enough selling power left in the shares to drive them all the way back down to the January 2016 lows. So yes, I'm more concerned with metals prices with respect to could there be a double bottom. That's where my concern would be.
And just for listeners that don't have a chart in front of them, what does that indicate for gold and silver prices?
Well, that would be for gold. That would be around 1040 an ounce. And for silver, I think that would be somewhere in the mid to upper, around the mid 13s.
Okay, so you're talking pretty ugly, and that would certainly have some implications for the mining shares, albeit maybe not as bad as they were.
Right. I mean, the mining shares in January 2016, the valuations that we saw, I mean, comparing them to the S&P 500, comparing them to the price of gold. I mean, we've talked about this in past interviews, but it was a historic low point, a major significant historical low. And, we had this fantastic move in 2016, but we haven't been able to sustain that and get into a bull market. And what that means is we're having, from a bird's eye view, we're having a retest of the low. That doesn't mean we're going to go and exactly make a double bottom, but when you're looking at charts, it's probably going to look like a higher low. It's just all the historical, the super long-term charts that I'm looking at, Colin, the valuations comparing gold stocks to the stock market to gold. essentially what I see is we made a historical epic low at the beginning of 2016, and now we're retesting that low, and it's going to end up being a higher low. And when that gets into place and goes in, we rebound from that low, which I think is going to be at some point next year. That's when we're going to get into a real bull market, which I know we'll talk about. The fundamentals, I think, for why I'm kind of bearish here over the next couple quarters, but extremely bullish after that.
Right. So let's talk about that. What gives? What is going to change things? You've done some historical analysis looking back at 1999 to 2001 over that bottoming process and past times, and you've come up with one kind of theme that seems to run throughout, and it has to do with the Fed. What is that?
Okay, well, I'll try and be quickly here because I can ramble on off topic, but this is really important. So there's two things that are underlying my outlook over the medium term and then the much longer term. Now, the first thing is the comparison to the mid to late 90s and early 2000s, and it's very interesting because the worst bear market ever was not this one. Well, it was this one for commodities, but before this one, look back to the mid 90s after the peak in 95 or 96. It was a horrific bear market for commodities, mine stocks, gold stocks. And interestingly, the Fed was not, interest rates were flat. They weren't hiking rates during that period. And in 1999, commodities kind of made it in gold. They kind of made a double bottom where they bottomed in 99 and then they made a second bottom in 2001. And that's when that bull market really took off. And what happened with respect to the Fed, Colin, is the Fed started hiking rates in 99. And so we had this big rally in hard assets. That's exactly what happened in 2016. The Fed, during the bear market, the Fed wasn't hiking rates. When they started hiking rates again, that's when commodities began this huge rally. Now, going back to the 99-01 period, what happened is after that first rate hike, when the Fed continued to hike rates, gold and precious metals and the gold stocks, they then trailed off, went sideways, kind of declined for a while. And after the next couple of Fed hikes, commodities actually performed better. And that's exactly what we've seen this time around. So during the last time, the stock market kept rising as they were hiking. Now, so what was the trigger that changed everything? Well, eventually we had the tech bust, problems in the economy. So the Fed stopped hiking rates. From the point when they stopped hiking rates to moving to their first cut, that is when precious metals essentially bottomed. And when they had that first cut, that's when they really took off and exploded. And, when the Fed made that first cut, it still took them, I believe, another year or so of cuts before the rest of commodities bottomed. And then another year after that is when the stock market bottomed. So I believe we could be setting up for something similar this time around, because when the last time, 99 to 2001, the Fed kept hiking, commodities did well for a little while, the stock market kept going up, but gold immediately trailed off after the rally, after the first hike. That's exactly what's happened this time around. They kept hiking. Gold, yeah, it's gone sideways, but now it's trailing off. As they kept hiking, silver and the gold stocks did not go sideways. They basically, they went sideways, but after they had a big correction. So from that point of view, that tells us that, when is this going to turn around in favor of gold and precious metals? Well, it's going to be when the Fed stops hiking. Somewhere around the point from their last hike to when they go to a pause, that's when precious metals are really going to turn around and outperform. And by the way, that makes total sense because we've been talking about how gold needs to outperform the stock market. It's been unable to do so in the last couple of years for a long period of time. And when the economy runs into issues, when the stock market rolls over, that's obviously going to be when the Fed is going to say, oh, damn, we need to stop hiking now. We need to go to a pause and maybe we'll go to cuts. So it all lines up with that. It all lines up as we've been talking about. Now, one more additional thing, Colin, is looking at history. And I'm just looking at Fed cycles and when they go to new hikes and they go to new cuts. Most of the time, and this is going back 60 years to the late 50s, the majority of the time, the most important lows in gold stocks, they coincide with the Fed stopping their hikes. Now, the times when that doesn't happen, there's sometimes two times in the 70s and then in 2004, I think, when precious metals were able to rise with rate hikes. And that's because inflation was really rising. very quickly. This time around, that hasn't happened because inflation hasn't gone up fast enough yet, despite the hikes for precious metals to keep rising and make new highs. So when I look at these two things historically, Fed policy and the fact that when they stop hiking, that usually tends to coincide with major gold stock bottoms. We look at that. We look at what happened in the 99 to 2001 cycle. We look at what's going on right now. The Fed's continued to hike. Precious metals are now trailing off. Gold failed to break out. When is it going to turn around? Well, if you look at history, it's pretty clear. The Fed is going to keep hiking. And, as the stock market keeps rising, when that changes, when the stock market stops rising, rolls over, we get into a recession, that's going to be when the Fed stops hiking, when they move to cuts. That's going to be when precious metals are going to start a major bull market. I see that happening sometime next year.
So if you were to open up the U.S. Fed funds rate and go back to the 70s, what you're saying could, from that chart alone, paint a pretty dismal picture because back in 1981, the Fed fund rate was as high as almost 20%. In 2007, we were above 5%. We stayed at 0 from 2008 until about 2015. And we're only at 2% now, talking about 2.5% later this year, 3% next year. I know that doesn't mean anything per se, but what if the Fed continues to be able to raise rates for 2 or 3 years in the future? You see no chance for gold?
Well, if something, it's a good question, because if something would play out differently and we don't get a recession, but we see a real upside explosion in inflation, then that would be very positive for gold. But if we continue this scenario of the Fed is going to be able to continue to do these baby step hikes for another 2 or 3 years, and inflation isn't really going to take off, yeah, that would be negative for gold. But I just don't see I don't see them being able to do that through more than for more than another 12, 15 months or so. I just don't see that being continuing to happen beyond next year into 2020. I think there's too many issues that are building up. And by the way, I think that when we get into the next economic cycle, it will, in my opinion, it's going to start with precious metals are going to bottom and begin a bull market as the Fed is cutting. But I think that next cycle could be when we see inflation really start to take off, because rates are going to be low. Rates are going to be rates and inflation are not going to be starting from negative or zero. They're going to be starting from a couple percent. And I think, not in the next year or two, but if we're looking at 3, 4, 5 years down the road, yes, we could see the Fed hiking again, but gold could be rising during that period because inflation could be, it could be going up much faster than the Fed hiking. So all the inflation that people have predicted, I think we're finally going to start to see that, but in the next economic cycle.
Excellent. Well, I think that paints a pretty good picture of where your head is at right now. Maybe not exactly what gold investors want to hear. I guess the last thing to touch on is, seasonally speaking, there's a chance that money comes into the space come the fall, and then you've also got gold. Seems pretty oversold right now, and that might not be something that kicks off a real long-term move. But what's the chance that we have some type of a solid rebound move here after this weakness we have exhibited?
Yeah, I do think we're setting up for a relief rally for sure, and I'm a little surprised it hasn't taken hold yet. Gold, maybe it needs to go a tiny bit lower before we get to a relief rally, but look, it is really oversold. Silver's really oversold. The dollar is consolidating here. It's really overbought on a short-term basis. So, I do think we are going to get some relief, but I think it's more likely to be during the summer than in the fall. So, that's what I'm looking for over the next, month or two. I think it's more likely that we're going to see a rebound than continued move lower. That's what I'm looking for, a rebound into the end of the summer, and then we'll see. If that fails and rolls over, then the fall and the rest of the year could be difficult. So yeah, in the immediate term, I'm not that bearish because we're really oversold and we're due for a relief rally.
Excellent. Well, Jordan, thank you for taking the time out on your Friday afternoon here. We will publish this on Saturday, the day after it's recorded, so it's nice and timely. Jordan Roy-Byrne, once again, publisher of thedailygold.com. Thanks for coming on.
Thanks for having me, Colin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?